From CGTN headquarters in Beijing, this is The Hub with Wang Guan.
Hello and welcome to The Hub on CGTN and Wang Guan in Beijing. Fresh data released on Tuesday from China's General Administration of Customs shows mixed results for imports and exports, and the drop in net foreign direct investment of China. Trade for the first 7 months grew year on year, but by a very slim margin of just 0.4%. On the other hand, China's GDP grew in the first half of the year, stood at 5.5%, which is in line with the full-year target of quote-unquote around 5% for the year 2023. So analysts are now trying to predict if global headwinds will bear down on China more heavily than expected, including the just announced technology restrictions announced by the Biden administration targeting China. What do these newly released data tell us about the state of the Chinese economy going forward? To discuss all these, I'm pleased to be joined from Singapore by Emmanuel Daniel, founder of the Asian Banker and co-author of the book, The Great Transition, The Personalization of Finance is here. From Henderson, Nevada, we have William Li, Chief Economist at the Milken Institute. In our Beijing studio, we have John Gong, Vice President of Research and Strategy at the Israel branch of the University of International Business and Economics. Gentlemen, welcome to the program. Let me start with you, William. In July, we have this data from National Bureau of Statistics releasing its quarterly findings showing that China's second quarter GDP growth stood at 6.3% year on year. That is a very high growth number, but if you put that into perspective, that is coming from a very low base of last year of 0.4%, when Shanghai was in lockdown, when much of China was in lockdown. What do you make of China's economic data?
Well, the way that most economists are looking at the GDP numbers is to look at the quarterly patterns. And you saw that the first quarter was very, very strong once the restrictions were lifted, but the momentum seemed to be disappearing in the second quarter. And that's the worrying aspect of it, is that the components that were slowing down were the components that would be the drivers for China's growth, which are domestic consumption, domestic investment, especially from the private sector. So those are the elements that we in the West and other analysts are worried about in terms of China sustaining its economic momentum.
Do you see any bright spots at all?
Oh, absolutely. In fact, the fact that the Chinese consumption was so strong in the first quarter, and with the lifting of restrictions, there was an enormous amount of international travel.
All right, Emmanuel, what do you make of the Chinese data? I mean, there are different components of it. If you look at investment, consumption, and next export, they tell us different stories. And as William has just put it, if you do it quarter by quarter or month by month, we see different things. William?
Well, I come from
sorry,
the
Emmanuel?
industry, yes?
Emmanuel, go ahead, sorry.
I come from the banking industry. I come from the banking industry, and what I saw was that there was a lot of liberalization of assets, of lending back into the economy, but a lot of that went to state-owned enterprises, and I think that's where the quarterly jump that we saw taking place. Some of it is state-sponsored incentives. What the state wanted to see was an increase in consumption, and that's where it continues to be soft. So you're right, it's very, very sectoral. At the moment, the state is sponsoring the growth in the hope that it will buy some time to see greater consumption.
Professor John Gong, thank you for joining us. Great to see you again in person after so many Zooms and Skypes.
Thank you very much. It's
great to see you again. Let's talk about these data. 5.5% for the first half of the year, which is in line for the 5% target set out from the National People's Congress, and 6.3% year on year for the second quarter. What do you make of these figures?
Well, I think it's generally expected that right after the pandemic is gone, there's a big spike in economic activities, and then there's going to be a tapering off. The expectation is that, or the hope is that the tapering off will not be that dramatic. But the second quarter number, even though it's 6.3%, as you said, very weak base last year. Overall, I would say that the recovery in the second quarter tends to be a little bit anemic. And it's anemic because of several reasons, in my view. One is that, I think in China right now, people who have money have already spent a lot of money, second quarter and first quarter. And we know that the savings at banks was very high, actually, for the last 2 years. So the people who have money have already spent a lot of money, in my view. It's the people who are financially constrained that are very lagging behind in terms of consumption. We're saying that consumption is weak. It's mostly coming from this group of people. It's not like they don't want to spend money. They don't want to consume. It's really they don't have money in the bank. And sometimes a lot of people still don't have full employment at this point. So I think the issue is really we need investment into the economy, especially from the private sector. And clearly, all indications are showing that these investments are very weak from the private sector. That hampers the creation of jobs that can percolate down to the income for these sort of middle to lower strata of the society, and that can eventually drive consumption. So I think my good friend Wang Guan, Wang Guan, right? Yeah. The dean at the Renmin University, Song-Yang Institute. He actually wrote a very interesting article recently. He said that the problem is really with respect to investment, and investment, how to propel and incentivize private investment is really the key to solve the current economic conundrum. So I think the government has been talking about and coming up with a couple of measures, right, policy measures, to try to jumpstart consumption as well as investment. And I think there's still a lot of room to strive in that direction. I think overall we really need to have a stable political as well as a market environment where the private investors have confidence and also have security to invest for the future. And I think these are the fundamental means to drive economic growth and also drive the income levels for the people who haven't really spent a lot of money so far.
On employment, or unemployment rather, youth unemployment data released by the Chinese government stood at 21.3%. That is considered the highest since 2018. We have 1.2 million college graduates going into the job market every year. Right. What do you make of this figure? Should we be alarmed?
Well, it's a very high number, of course. At surface level, we think it is very shocking and should be definitely very concerned about. But I think, as economists, I do want to point out the difference between this number and the traditional unemployment figure, as we understand it. My understanding is that this number is collected at a university level. At the time when students graduate from a university, to see how many people have a job on hand, how many students who don't have a job. And clearly this number is not going to be remaining the same month after month after they graduate. It's going to come down. It's going to take some time for some students to find a job. And so this number, unlike the unemployment number, which tends to be a little bit stable, right? 4%, 5%, month after month, month after month. This number is going to go down. We know this number is going down. This is a very specific towards the graduating wave of students. It's only talking about these students. So I think
instead of everyone seeking a job in the job market,
the graduate students, who are graduating this year, right, this semester, and for some of them, it's going to take some little bit of time for them to find jobs. So, but let's say 6 months after this number is collected, I would bet that 20% is not going to be 20%. It's going to be maybe 15%, 10% even, right? So as time goes by, this number is going to drop down. The question is how much lower it's going to drop down. So I think this number, at least in my view, when we compare to the traditional unemployment figure, this number should be taken with a grain of salt. It's not the traditional unemployment figure as we think about it.
All right. You're saying that it's structural unemployment with seasonal factors kicking in. William, how do you look at the Chinese youth unemployment figure, which stood at 21.3%?
Well, John has an interesting spin on that number, the fact that it will go down over time. And I as an analyst from the West, I've looked at that number for the pre-COVID period, and it was much lower. So it says a lot about the ability of the Chinese economy to absorb new graduates now compared to pre-COVID, and it clearly is much more difficult. There's been changes in the attitude of the government toward the private sector, which is the main absorber of college graduates. Some of the high-tech companies, the Alibabas, Tencents, and internet companies have been told to cut back on their activities because they were not doing things in a way that was to the approval of the state authorities. And so I think that's one of the problems, is that one of the main absorbers of the youth graduating from college, that sector has been, the policies have been sort of flip-flopping from one side to the other. And I think if the government were to really encourage the private sector to be more confident that it will be supported by the state, I think the absorption problem will be solved much more quickly.
William, you talk about the private sector. Recently, the Politburo, all-powerful organization within the CPC, as well as the State Council of China, both issued directives. They held seminars, issuing policy documents saying that they will stimulate the private enterprises. How do you see the gestures from the very top trickling down to hopefully stimulate the private sector?
That was the best news I've heard in the last year, that the State Council and the government really has tried to reaffirm its support for the market economy, its support for the private sector, and its recognition of the importance of the private sector in the Chinese economy. And I think that's the best news that we've heard yet, and I hope that it will actually be implemented in actual policies, that instead of just themes that were talked about, that the actual policies that have been put in place will allow the private sector to expand and thrive.
Emmanuel, let me ask you about the real estate sector, which has been a main driver of the Chinese economy. Recently, the Chinese government issued new policies encouraging banks to lower interest rates on existing mortgages and also hopefully to lower down payment for first properties of residents. How much of a stimulus do you think that will be?
Well, that's Wang Guan. That's what I referred to in my first comment on the GDP growth, which is that a lot of it has been structural and very focused on the banking system. And so releasing liquidity into the marketplace was one of the first things the government did after COVID. And that's the number that we are seeing in the GDP growth figures. In terms of property demand and asset creation, we've not seen inflation going up very much. In fact, China is the one country in the world that is not seeing inflationary pressures, and it can do well with much more inflation. With inflation, the application of bank lending to assets becomes more meaningful. And there we start to look at demand for property. And I think that what's driving that is a very soft sentiment in the property market, although there has been incentives to continue construction and so on. From an external point of view, what China really needs to build on, and I think that the government is buying time to build these structures, is to also expand the asset classes so that it will not be property centric. It's very easy to go in back and create demand, but I think that the overall intention is to broaden demand base, and that's a harder thing to do.
Emmanuel, you talk about inflation. In fact, the inflation figure for July for China is minus 0.3%. So some people are asking if China is facing deflationary pressure. How big a problem is that?
Wang Guan, from outside of China, that's the big question that is being asked. Is China entering a deflationary phase? Not necessarily so. There is still time to recreate demand and spending, and China does have a very strong domestic marketplace. And I think that it's also affected by external demand. So it's not a China problem, it's a global problem where external demand is weak at the moment. And I think that once we see the global trade figures start to ramp up, it will have an effect on demand in China, and in return, wages, and then from wages back to inflation again.
And let's talk about trade. According to the latest release from the General Administration of Customs of China on Tuesday, China's total imports and exports expanded by 0.4% to around 23 trillion yuan, that is $3 trillion US in the first 7 months of the year. Compared with the same period last year, exports reached 13.5 trillion yuan, while imports reached 10 million yuan, seeing a 1.5% increase. and a 1.1% decrease, respectively. But in May, export dropped to minus 7.5%, dropped by 7.5%. June, minus 12.4%. Those are the export decreases. Professor Zhang, what do you make of these trade figures?
Well, exports are certainly weakening in the last few months, but I think what's still a little bit comforting to me is that at least it's not just China specific. I mean, across the board, exports have been weak. I mean, if we compare China's exports with, say, South Korea, Vietnam, actually China's not bad at all. So it's not just a China problem; it's the entire global problem right now because we are facing economic headwinds. However, I do want to point out that there might be also structural changes going on as well. I know a lot of companies in China, foreign companies operating in China, have been adopting the China Plus One strategy, right? So the decoupling.
China Plus One.
Yeah, China Plus One. Yeah. So which means that they have operations in China, but they also want to establish another location of production outside of China as part of the supply chain network. A lot of companies went to Mexico, for example, right? So this is part of the outcomes designed by Washington, what they call decoupling or de-risking, whatever they call it. I think we should not underestimate that impact. I think it's indeed happening. I certainly hope that the extent of this happening is very limited, but we don't know yet. We have to see in the long run whether this is going to be, whether it's going to materialize in a major way. However, I do want to point out there's a very bright spot in China's exports in the last few months. That has to do with the trade with Russia. And if you look at the chart of China's exports with a list of the largest trading partner countries, they're all minus percentage points. Right?
Japan, with Korea, with the United States, the EU.
With almost everyone. But with Russia, it's a 70% increase. Yeah. So I think Russia is becoming rapidly as one of the largest trading partners of China as a single country. My projection is that the total trade with Russia by the end of this year will be maybe close to $250 billion. I mean, that's a huge number. The two governments have announced that they strive to reach $200 billion number. That number is going to be passed for sure, I think. So I think, I just came back from Russia a few weeks ago, actually. On the streets of Russia, for example, you'll see more and more cars from China, companies like Geely, Chery, Great Wall Havel, they're all doing great in Russia. So I think, at least in a sort of a very strong geopolitical, geostrategic trend, in my view, vis-a-vis the West, particularly the United States, at least one area, one region that is seeing a big increase in demand for Chinese products, that is Russia. Hopefully, this demand increase will somehow compensate for the loss of business with these Western countries.
Yeah. William, let me turn to you. Professor John Gong just made an excellent point in that we're entering an era of geopoliticization of international trade. However you look at it, trade with ASEAN, between China and ASEAN increased. Russia trade increased, and China's trade with Belt and Road countries increased significantly to 8 trillion yuan with a 7.5% jump. That is a year-on-year figure. How do you look at this trend?
Well, globalization is restructuring. The traditional trade that used to go on was China was the supplier of goods for the whole world. And because of COVID, I think most countries have learned that they need to at least supplement their supply chains and to be able to regionalize trade much more. And China has benefited from that because ASEAN, as you said, and Asia have become major trading partners along with Russia for China. So the regionalization of trade is something that has happened structurally. One of the other things that accounts for the drop in the volume of exports from China is the shift in demand. Most of the demand in the United States and Europe and UK is going towards services and away from goods in the post-COVID environment. And China's main exports are goods. So right now, I think we're seeing that happen. And I think once the mix of goods versus services stabilizes and China opens up for tourism and other services, I think you'll see China's exports start to pick up again. But one of the things that I think we need to worry about, though, is how China will adapt to globalization, version 2, which is a much more regionalized set of supply chains, and how the United States tensions with China will contribute to that. I, for one, think that the tensions themselves account for very little of the trade drop-off that we've seen so far. It is very much in specialized sectors like advanced semiconductors. But in terms of the overall goods that have been produced by China, like electric vehicles, I think the demand for those have been fairly strong and growing over time.
Yeah, we've seen a lot of nearshoring and friendshoring. On the other hand, China's trade data with the EU edged down 0.1% from a year earlier, and China's trade with the United States and Japan, yeah, that's what you see on the big screen, declined 9.6% and 5.8% respectively in the first 7 months of the year. Other than geopolitics, what are some of the other factors, resulting in these figures? What about the Fed's rate hike and, tightening of monetary policies?
Oh, absolutely. In fact, the big thing that accounts for the drop in the volume of exports is the fact that the U.S., Europe, and UK are fighting inflation, and they're slowing the U.S. and European economies down in order to lower the inflation rate. But as I said, the shift from from goods to services is also the other major factor that accounts for that drop-off in the volume of China exports.
Emmanuel, when I picked up the phone this morning, another piece of announcement from the Joe Biden administration signing an executive order that restricts certain American investments on the Chinese mainland, Hong Kong, and Macau in high-tech sectors, including artificial intelligence, semiconductors, and quantum computing. Of course, the rationale behind allegedly was to, address issues of concern, over these sensitive technologies, protecting American national security. What do you make of these new executive orders issued by Washington targeting Chinese high-tech sectors?
Well, we look back to history to see what happens every time the U.S. puts in trade sanctions. It affects the U.S. more than it affects anyone else. And there's price discovery problems. There is, the symmetry of knowledge is affected, and so on. And it has an impact that works right back into the U.S. economy. So we don't have to worry about, the headline news, as it were. But all economies are facing new challenges because of AI, greater productivity, which is one topic that we've not had discussed in this conversation, and the impact that it has on employment and breakthroughs in new technologies. And I think that on that front, both the U.S. and China are on the same footing. And the way to look for an answer as to where that's going to direct us is to track and follow where capital is flowing. And as long as, whether it's China or the US, the corporations have access to capital, that's where the answer will be in terms of who will make headways as a result. At the same time, there are developments taking place under the headline. So China and ASEAN, for example, have the world's most developed free trade agreement arrangement. And so when we think about China, we actually think about China and the ASEAN region to figure out how trade flows are rearranging themselves, how supply chains are rearranging themselves, and how they are exporting to other markets. So if you see the aggregate play of China plus Southeast Asia with the EU or with the US, it will paint a very interesting story that is actually much more meaningful than the headlines.
Emmanuel, do we have conclusive evidence as to the direction of capital flows? Because some chambers of commerce here in Beijing say capital are flowing out of China to other Southeast Asian countries, for example, but other data suggests that the opposite is true. Now,
there's a huge battlefield underway at the moment. What China has is a government that is willing to go into deficit for long periods of time and able to do that in order to fund capital flows within the economy. And that's what they're doing. The US does not have that ability. But in terms of free market capital, yes, it is swirling around the world, looking for alternatives, both because of geopolitics, but also because of efficiencies and the comparative advantage of different countries. When we talk about China plus one, the countries that are benefiting from China from plus one are the countries who are themselves maturing into a phase of the economy which is one step, related to China in that way. So it has to be an economy that can work in tandem with the development that China is in right now.
Yeah, another major issue is climate change. Professor John Gong, we've seen extreme weather patterns. We suffered from it recently in Beijing, record rainfall, and we've been talking with World Meteorological Organization Director General, who's saying that this trend will continue until 2060, independent of what we're doing here on the ground. And talks are about the autumn harvest of China and the flooded fields in northeast of China. How big a concern is that?
Well, my heart goes to the people who are affected by this, especially those families who lost family members because of this very unfortunate event. I hope them well, and I hope that the recovery will happen very soon. Nevertheless, having said that, I think from an economist point of view, it's kind of a little bit of a sinister theory that natural disasters are not necessarily bad things from an economic development point of view. I mean, you can think about how much efforts, how much capital, how much materials will be pumped into the northern part of China in this region, Hebei province, to reconstruct their homeland, right? That's all GDP. If you think about it, that's all GDP. So I think this natural disaster, aside from all its bad impact, all its unfortunate impact, it does provide a big opportunity for investment in the next quarter. And that will probably contribute to maybe 0.5% of the GDP growth in China next quarter. And moving forward, I think more importantly, it's the investment related to the climate change. I think in China we have a big initiative towards investment towards climate-related agenda, green investment, and that's a huge industry. Unfortunately, Chinese companies, Chinese technology is actually quite leading in this area, in photovoltaic, for example, in battery making, in battery storage, in all these cutting-edge technologies. Chinese companies are leading, and also are leading in the market leading the marketplace as well. So that's a very good thing to see, and I hope that trend will continue.
Of course, that is the hope of many. William, how do you look at the impact of climate change on the world economies?
I want to echo what John just said about the tragedy and loss of lives as a result of this, especially in the provinces that are just north of Beijing. It's so unusual, and I think one of the things that it will lead to will be agricultural shortages. Now, fortunately, because of the trade that China has with Russia, perhaps some of that Ukrainian wheat and oil and cooking oil will find its way into China to try to make up for the short-term shortages that will inevitably occur after things settle down later on this year. And to get back to your point about the original sanctions and how that has changed the leading-edge industries like quantum computing and semiconductors in China, most of the funding from that comes from China. 80% to 85% of the funding for those sectors come from within China. So the sources of foreign capital coming in are really a very small component of that. And the fact that the Biden administration has put restrictions on U.S. investors coming in, I think will have a minimal effect on China's ability to advance in those areas, of which it is very much a leader in many of those areas.
William, John, and Emmanuel, thank you all so very much. And we're coming to the end of this edition of The Hub on CGTN. Thank you so much for tuning in. I'm Wang Guan in Beijing. Bye and take care. Thank you, Professor John. Great.